Welcome to Fintech Family Hour. This is Zach Anderson-Pettit, content director at Money 2020 by day, and your host by night. Fintech Family Hour is now on YouTube. Go check it out and subscribe. Alex is a regular guest on the show for a reason. I love talking to him. It's pretty much that simple. This time, though, we dig into one very specific subject. We dig into the world of credit scoring, the history, the present state, and we have some fun thinking about what the future could look like. This episode is brought to you by Skipify. Go to skipify.com to learn more. And without further adu, here's Alex. Alex Johnson, welcome to the podcast, my friend. This is your fourth? Fifth? I have no idea. You've been on the podcast a number of times.
I mean, like, this is like a Steve Martin SNL hosting thing. Like, who has the record?
It might be you.
I'd like to have the record.
It's you or Kristen might, just because of the co-hosting.
Right.
Yeah.
All right. Well, if I lose to Kristen, that's acceptable.
We all lose to Kristen.
Exactly.
That's
so
how life works.
That's totally fine. I understand. Second place is not embarrassing in that case.
No. If anything, I mean, it will be tomorrow morning when we play basketball together. Oh, all right.
The trash talk starts already. I believe it too. Zach is like an incredible athlete. He doesn't like to tell people this, but it is true.
I am not. But we can play for $5 a game if you want.
See, he's already with this stuff. It's going to be super embarrassing. Ever since I had kids, whatever limited skill and ability I had is completely gone.
Yeah, watch me completely shit the bed tomorrow when we get there.
Well, so I'm sort of hoping. I don't know if you ever had this, but like there's like a dad energy to playing sports that I feel.
You about to Caitlin Clark me tomorrow?
I think I might just be like we're gonna go to the post. I'm gonna use my like surprising dad strength and just overpower you. That's the plan. Just like old school like
Alex Johnson shacked.
I'm gonna put you in the basket, except I can't dunk, so I'm just gonna like lay it up gently
and then just miss a free throw.
Yeah, exactly.
Yeah,
exactly,
perfect.
Yeah.
Okay, so we got it nailed down.
Okay.
All right, so we're gonna start in a unique way where I actually have questions.
Wow.
I know.
This is not my first time on the podcast. This is my first time on like the podcast, though.
That's true.
Okay.
That's true. This is
true,
This is
right?
our first time doing like, I got to get this thing out
First
of the way.
solo
Jesus.
pod, right?
Yes, first solo pod together.
Got questions and everything.
What a nice moment.
I know.
Let's just let that soak in for a second. But you have a hard stop, so not very long. Okay, so we're going to talk about credit scoring. You have written about it a lot. You've written about credit builder products, especially. You've written about, and you come from that world.
Yep.
And you and I have a hilarious friendship where we talk often here and there. Mm-hmm. We talk on the phone, but like when we actually get together, we tend to like, well, what are we doing if we don't record it?
Exactly.
So we were thinking about different ways to do it, what to talk about. And it hit me last night as we were trying to like put groups of 3 and 4 together that like, let's just talk about the most important thing in consumer finance from my perspective, and potentially one of the most interesting things over the next however many years. You pointed out recently on one of your podcasts that open banking could have a big impact on this, things along those lines. So we're going to talk credit scoring, but we're going to go in some different directions as far as that goes. And we're going to prognosticate.
Excellent.
The first piece, though, is people know you. People generally have a sense of kind of, what you're writing about in your current state. Yeah. But I don't think every single listener and watcher in the audience will have the full background of like, we used to work at FICO, that whole thing. So give us a little bit of like, I guess the Alex background, but especially like, tell me about your credit scoring history or your credit bureau history. I don't know how to phrase this.
No, it's a good question. like, why do you know anything about credit scores?
Yeah, that's basically what I'm asking, but I didn't want to phrase it that way.
It's totally fair. And I will be honest, like not a data scientist, right? And so my knowledge of credit and credit scoring is more from a, I guess, business background than it is like a deep data science. So don't ask me like data science questions.
Well, but how much of the data science even totally is answerable? Like even if I had a data scientist sitting here with me and I was like, well, if this happened and then you did 2 hard pulls, what would happen? Like
they can give you a more complex answer, but it's basically the same answer, right? And so we'll give you the simple version. But for background, I mean, I've worked mostly in and around credit my whole life, my whole professional career. And so that's really been the space I've focused on. My first job was actually at a company that did credit decisioning. So basically built the technology to take in credit data and credit scores and then turn it into a yes or a no for banks. And so got to know...
When was that?
That was... 2004 was when I got my job there as an intern. And so this was like...
What kind of technology was? I mean, that's like...
So
how this has all changed is fascinating to me.
It's crazy. I mean, so kind of similar to like, imagine like an Alloy or someone like that in terms of like a decisioning platform that takes in data and makes a decision. But the company I was working for, they were founded in 1990. So like way before fintech was a thing. They just happened to be based in Bozeman, Montana, which is how I got a job there. And there was no AWS, right? No cloud computing. So they built their own cloud computing environment data center in a field in Bozeman, Montana, and convinced big banks to use it.
That's wild.
And like, there was no real VC interest in like financial technology. And so the founder bootstrapped the company and still owns 100% of it. So like a very non-fintech company in a lot of ways.
And it's still open, still a thing today?
Still a thing today. Zoot Enterprises based in Bozeman, Montana.
Zoot!
Yeah.
That is a wonderful name.
It's great. And so I got a job working in marketing there, and I was 16. It was a high school internship. And
my God, Alex, I didn't know you went that far back.
Oh man.
Like in my head, you started all this like post-college or
something.
High school intern. You were 16 when you started on credit decisioning?
I was a junior in high school, and they sat me down and they're like,
you had a thin file at that point, my friend.
I had a very thin file. And they were like, so credit, like, do you know how that works? I'm like, no, I have no idea how any of this works. And so they sat me down and they walked me through all of it. And we had to pass like compliance tests to work at the company because anyone who like kind of is close to credit decisioning or whatever, like they wanted to make sure everyone was in compliance with the law. So like every year we'd take these tests on like, the Fair Credit Reporting Act and what does it require? And I took pride in like acing those tests. So I studied really hard to learn about how this whole system works. And after I had a couple years of experience working there, I thought I was an expert, as one tends to do when you're 18 and anything.
That's the vibe.
Yeah.
Like, that's the vibe.
I was like, okay, like I'm pretty much like an expert in this. And so I actually started a credit education program in my spare time.
18?
And I was 18.
Oh
so what I was doing was I was going into high schools and middle schools and teaching high school and middle school students about credit and credit reporting and how that works. So anyone who ever says like...
And you still did you have a credit score?
No. I don't know who I was to like lecture these people who were like 2, 3, 4 years younger than I was, but here I am like in class like teaching.
To be a white man with an entrepreneurial bug, it's just like the level of like
put me in there. Like I'm pretty sure I know what I'm doing.
I think I've been doing this for years. We're ready to go.
This is my like founder journey in a nutshell. Yeah. So so like anyone who ever talks about like financial literacy, like I always shut them down and be like, until you've taught bored high school students financial literacy, like don't talk about financial literacy. So I have a whole set of opinions on that, but got to know kind of credit from that perspective. And, again, thought I knew everything about it. Then discovered that, of course, as with anything, there's a whole universe hiding under the surface of what you think you know. And the most like interesting stuff is when you start to know enough to get a glimpse of that larger universe and go, oh, I didn't know. I don't know anything.
Yeah.
Like as soon as you get enough knowledge to know, like, yeah, exactly. Like I'm out over an ocean that is thousands of feet deep and there's stuff down there that I can't even fathom. Like as soon as you get a glimpse of that, it's super humbling, right? And so I had that experience towards the end of my time at Zoot. And so then I was like, well, how do I learn more about this? And so I ended up getting a job at FICO, credit scoring company. And
that was post-college.
That was post-college.
Okay.
Yes, that was post-college.
I thought you were like, I was 19.
Yeah. No, I was a little older and a little bit more experienced then, but still, you think you know how this stuff works. And I had been around credit decisioning and credit bureaus and credit files. And so I thought I knew how it worked. And what's interesting about FICO and credit scoring and the credit bureaus is there's a very sort of hidden relationship between all those companies in terms of how credit scoring works. And to be clear, I did not work in the credit scoring group at FICO. I worked more on the software side. But when you're in the building, you're like close enough to the firewall that you can kind of like get a glimpse of how it works. And it's fascinating because there's just all of these discussions and debates and stuff that are happening around credit scoring that I don't know how you would learn about it otherwise. Like you almost have to be in the building to see it up close, but you get to kind of see the machinery and how it works. And I emerged from that experience with honestly a much more sort of profound appreciation for the credit system we have in the US. And anyone in fintech, I think, can very easily rattle off like why credit scoring is bad, why the credit bureaus are bad. And certainly they are flawed in many ways. And I can go into all of that. But The US is also one of the most kind of robust credit economies in the world, probably the most robust credit economy in the world.
Who could challenge us?
No, I mean, like it's us, and I don't even know who would be second, honestly.
I mean, the American dream has changed into thou shalt have a credit card and like run that balance up.
That's right. And I've actually been reading a lot of books about like the history, the nerd I am, about the history of credit in the US and consumer credit and where the credit bureaus came from. And, it takes a lot to like understand the system that we have and how it's evolved. Like to give you one example, I was going back through old congressional testimony from the 60s.
Stop. I'm getting excited.
I know. And it's interesting because post World War II, companies started to think, well, what can we do with this computer technology that was designed to like fight the Nazis in World War II? Like, could we apply it in like a private industry context? So they started thinking about what could we digitize, right?
Wait, so you're tying credit scoring back to like Alan Turing right now.
Yeah. Because I mean, most of the like modern computer technology we have today was built to fight in World War II. Right. That's where it came from. So after World War II, all these people who knew about computers and computer databases, they started thinking about, well, what else can we use this for, right? Like we were using it to calculate radar solutions to sink Nazi submarines. Now what can we use this stuff for? And one of the big use cases was credit and lending. And so if you go back to like 1968 roughly, that's about when this started to happen. And what's funny, because we talk a lot about like privacy and stuff today, is people in Congress, when they first got wind of, you're going to take our data and put it in a database that we don't see, but that determines our future, they freaked out. They completely and utterly freaked out. And so Congress pulled all of these folks who worked at these credit bureaus at the time up to this big congressional hearing that they did. And their goal was to try to find out, how do credit bureaus work and what's going to happen when we digitize this system. And like, I'm telling you, the testimony from there was wild. Like they were interviewing this woman and she was like, yeah, I didn't get a job that I applied for. And they're like, why? And it turns out that the credit bureau that eventually became Equifax, actually, they sent a private investigator into her neighborhood to interview her neighbors. And one of her neighbors said that she was psychotic because they had some kind of like grudge or something. And the word psychotic made it into her Equifax credit file. And then when her employer pulled her credit file, they saw that and they didn't give her the job. And so there are all these stories coming out at the time about how this system used to work. And it used to be entirely based on what merchants and your neighbors and your employers would say about you. Totally unverified.
It's qualitative, completely. That's
qualitative,
bonkers.
Completely biased. And it would make, and obviously there's a ton of like racial and gender discrimination in there, as
of course.
You might imagine.
And
Come all on, of Alex. That, I mean, it was like bad.
Of course.
Really bad.
Of course
and
it was.
So all of that was in these paper files. And you would call up the credit bureau and they would basically read you the file over the phone. And that's how credit decisioning worked at the time, right? So like deeply biased, bad data. And then of course, the person making the decision was a human who had their own biases. Really bad. So when they were talking about how it's going to work when we digitize this and what that experience is going to be like, what they figured out was, actually, if we do this with computer databases and the feeds going into those databases are coming from other digitized systems, so we'll just connect right to a computer system at a bank. It's going to feed us this information. There's going to be no human in the middle. There's going to be no paper file. The data will actually get better. It'll be less biased. It'll just be data that we're looking for, like, did you repay this loan? How many loans have you taken out? How many inquiries have you had? That kind of stuff. And it's all going to be relatively accurate and maintained in an orderly way. Credit bureaus got 1,000 times better when we digitize them. And so you fast forward from the 1960s, where every big city in the US has their own credit bureau that works in a very sort of offline fashion, to the system we have today, which is 3 credit bureaus for the most part, with massive databases that are mostly driven by computers. And are there errors in there? Yes, absolutely. Do they occasionally get breached, as Equifax did? Yes, absolutely. Like, there are huge problems, but the system we have is kind of a marvel of modern technology and financial engineering.
It feels like, I mean, a very strong overlap to just about everything, not just about everything, but a lot of things in the US where we have this general perspective of like, well, this sucks and we are Americans, therefore it should be better. But if you look at like the rest of the world, or you look at just how it came to be, or you like, as you dig into it, you're like, oh, that actually makes a lot of sense. And we're doing way better than we realized. It's like being born here. Like you're already on third base running home.
Exactly. And you're like, God, it sucks to be on third base. I mean, I was interviewing the head of the payments infrastructure at the Federal Reserve on the podcast last year.
Mr. Gould, or which person?
Mr. Gould, yeah.
Okay.
And
hello, Mr. Gould.
Hello, Mr. Gould. And very good discussion. You've met him. Good guy. And we were kind of talking about FedNow, but in the context of that conversation, he was talking about like scale and that kind of stuff. And he was like, yeah, I think like last quarter, we did something like $7 trillion in payments through the ACH system. And I like fell out of my chair. And to them, it's like not a big deal.
Why'd you fall out of your... That doesn't surprise me.
Well, I mean, that's a big number.
It's a number that is so big, it doesn't make sense.
It doesn't even make any sense.
Yeah,
and it's
that's like, how I feel about all of it now.
Right. And so you're like, yeah, like, is the ACH system kind of slow? Yes. Does it have some problems? Yes. Is there fraud associated with it? Absolutely. But like, they move $7 trillion a quarter. Like, it's a lot of money that goes to that system, and it never breaks. It works all the time. So I think you're right. We don't appreciate the infrastructure we have nearly as much. So when I think about credit scoring, the credit bureaus, credit files, open banking, I try to think about it in that context of the system we have actually works pretty well. What can we do to make it better?
And if you think back on the way you just described the credit scoring system, it directly reflects the way that, especially, I mean, the backbone of the United States, like community banks, were making lending decisions throughout the entire time, right? Like the idea of talking to your neighbor, the idea of knowing the banker, the idea of the whole 9 yards in terms of like, well, I just feel like that's probably a responsible individual. And you at one point could make a loan basically on that.
That's right. Well, and the thing that's interesting is I've been trying to think about when did financial services change, right? And looking at it from sort of a historical perspective. And I think I actually have pinpointed an exact year that financial services changed. Are you ready?
I'm on the edge of, I'm not, but I'm on the edge of my seat metaphorically.
Yeah, metaphorically. So the year banking changed forever, 1994. What were you doing in 1994?
I was 3.
Okay, right.
So
it
was my first internship.
Same, right? Yeah, same. You were learning about payments and starting to dig into that whole space.
Yeah. I lived right next to a check cashing place, so in my own way.
Yeah, right. You know? You're getting some kind of like some experience experientially.
So why?
So 1994, 2 things happened. One, it's the year of the internet. So this is when the consumer internet, as we understand it today, is first taking off. And it is exploding. I think something like 10 million users get online that year. It's called the year of the web. That's how it's referred to. That's when Tim Berners-Lee, who basically invented the internet, left CERN and went to go found W3C. So like that is the year of the internet. It first starts taking off. People first start getting their hands on it. At the same time, that's also when we passed the Interstate Banking Act, which allowed...
That was in 94?
That was in 1994. Bill Clinton signed that law, and that allowed for banks to expand across state lines. So when you think about what you were just saying, right? Banking is local. It's based on community. It's, your banker knows you. Your neighbors know you. That's how banking works. Not in 1994, post 1994. And of course, it took decades for this change to play itself out. Suddenly you have banks that are competing nationally, right? And so now it's not your community bank that wants your business. It's every bank in the US can theoretically have you as a customer. And the question is, if they don't have branches in your neighborhood, how are they going to reach you? The internet. And so now we have this system where the distribution, both from a regulatory perspective and from a technology perspective, has completely changed in financial services. And the question is, how does all of the infrastructure have to evolve or change to support that, right? You can't make credit decisions based on what someone in one community knows about you. Yeah. We need a national infrastructure to enable this new financial services system that we have that started in 1994. Luckily, the credit bureaus had, even before 1994, been building to the point where they had this national infrastructure. So I think we take it for granted that someone can be working with a lender that's based in Kansas City. I'm in Montana, but they don't need to know anything about me personally or my role in the Bozeman, Montana community and economy to be able to underwrite me for a loan because I have a credit file at the 3 credit bureaus.
This is not related to what we were talking about, but now I'm just going to ask a historical question.
Yeah.
So there's federally chartered banks, there's state chartered banks.
Yeah.
Federally chartered banks were still at that in 93, they were still functioning across the nation, right? Or were they individually chartered in all 50 states?
They were individually chartered in the different states.
Whoa.
Yeah. And so if you go back to like look at credit cards as an example.
I feel like this is one of those things I should have known already.
Right. No. I did not know this until I started reading about the history. It's fascinating, right? Like you think, again, you're over deep water. You think you know these things, and then you don't. You look at like credit cards, right? Credit cards got started in Fresno, California.
Yeah, I was wondering,
right?
Like, how does this relate to the drop? Because I feel like the drop and this have like a direct parallel path of like one feeds the other.
They absolutely do, right? Because Bank of America, based in California, invents the general purpose credit card, Fresno, California. The problem is that it starts working really well in California, and Bank of America is like, well, we want to take advantage of this. Like other banks should be using this. So they franchise their credit card business out to other banks working in other parts of the country. So Bank of America can't nationally roll out a credit card to everyone because they can't work across state lines that way. So they start franchising it. And that franchise business is what eventually grows into Visa. And so a lot of these things have their roots in, are you allowed to operate across state lines? No. Okay, what's the alternative that we have to put in place in order to get around those restrictions? 1994, those restrictions get basically wiped off the table, both from a legal regulatory perspective with the Interstate Banking Act and, again, with the internet. And it took decades for that trend to play itself out. And if you go back to the late 90s and early 2000s, banks like Bank of America were like, oh, hell yes. Like now we can become like large national banks, the banks we know today. But they were building branches. They were expanding geographically. They had this universal banking model they were pursuing. Even they didn't see the value of the internet at that time. And it took another 20 years, 30 years for that part to play itself out. And now, of course, when we look at banks, even like a JP Morgan Chase or Bank of America that's building new branches, we sort of look at them like they've lost their minds. But it's because, even they are having a tough time catching up to this idea that literally you can be a bank based anywhere. And as long as you have a charter, you can compete for any customers wherever you are. And that is fintech and all of the things that we deal with today.
This episode of Fintech Family Hour is brought to you by Skipify. You'll get to hear much more about Skipify in the coming months here on Fintech Family Hour and why they've caught the attention of some of the smartest leaders in payments. Their CEO, Rith Martin, will be joining us on our next episode. Not this one, but wait a week. Here he comes, live from New York Fintech Week. I promise you that one is a treat and one of the more unique episodes I've ever done. Standing out on a pier, stretching, trying to make sure our backs don't hurt. It was a good time. But if you're not familiar with Skipify, it's a next generation digital wallet that connects financial institutions with merchants and shoppers at the moment of purchase for the first time, allowing for a friction-free shopping experience for cardholders wherever they shop. Skipify's connected wallet, integrated at the merchant level, is used by banks to customize the shopper journey with points offers, merchant rewards, and alternative payment methods. With Skipify, banks are able to increase their share of wallet and authorize up to 99%. Hold on, my voice can get higher. 99% of transactions without any increase in fraud. You heard that right, folks. With financial institution partners like Amex, Synchrony, and most recently, Visa, this fintech is well on its way to checkout domination. That's right, I said it. To learn more and get personalized demo of Skipify's connected wallet, go to skipify.com. Okay, so this makes a ton of sense. So there's, as everything you're describing is also a gigantic corpus of data that is quantitative, not qualitative, being fed into the system. So over time, we're digitally developing an actual score, not just like it seems like a good person sort of thing, right? Okay, so we get to that point. There's a score that's developed. It's not just qualitative. How, thinking about fintech, thinking about the 10, 15 years that we've had, how has credit scoring kept up with innovation? It's a weird question, but I'm thinking about cash flow underwriting, thinking about things like that. It feels like, to me, cash flow underwriting feels like one of the only things that really has happened to innovate in that space.
I think that's absolutely true. I mean, one of the things that's really tough about credit decisioning and credit scoring is there's two different questions. What data could I use to guess, to predict if you're going to pay me back if I give you a loan? There's a lot of data you could use to do that.
You're talking willingness to repay.
Yes.
In terms of that piece.
Yes,
okay.
Exactly. Like if I just as a data scientist, if I wanted, and again, I'm not a data scientist, but if I wanted to just predict your likelihood to repay, there's lots of data you could use. It all has different, I think of it as like caloric value. So like how many calories does this particular data source provide for making a credit decision? Credit bureau data is great. Very high calorie, really predictive data. But just as an example, like if you type in all caps on all your LinkedIn updates, that probably has some caloric value to me making a credit decision about you. And they've tested this, right? Like there's
Unpack
all kinds of...
What did you just say?
Behavior stuff, right? Do you type in all caps? How much time do you spend on social media? How good a driver are you? Like there's
I'm so stuck on the all caps piece though. Just all caps just make you...
It's just my favorite example.
That's a real thing though?
It's a real thing. They've looked at it and they've basically found a slight predictive value in like how you type on the internet and like how you interact with people and how you post on social. Like they can look at that and they can parse out like...
That's fascinating.
It's correlated, right? So they find these correlations and they're slight, but they're helpful. So if you were a data scientist, what you'd want is give me all the data. And I mean like all the data on consumers. I will plug it all in and I'll build this like master score that will be super predictive. Different data sources have different levels of value, but as a data scientist, you'd want all the data. Second question is, what data is fair to use for a credit decision? And generally speaking, and this is what most of our laws and regulations are built around, is this idea that the data that we use to make a credit decision about you should be data that we think is fair, meaning that you should, as a consumer, be able to understand why you were declined. And in fact, under the Fair Credit Reporting Act, we have a legal obligation to give you an explanation if you're declined for credit. So we have to tell you why you were declined. That breaks almost all of the types of data that you might use to make a credit decision. Because Zach, if I tell you we declined you because you typed in all caps on LinkedIn, what are you going to do?
My caps lock it's been stuck for years.
Right. And then maybe you'll get a new keyboard where your caps lock is suddenly unstuck, magic, and suddenly your score goes up. So we can't give you a view into our black box algorithm that looks at this data and not have you game that algorithm. So the thing that's nice about the established credit file and credit score is you can't game it, right? If I go to you and, I ask for a loan and you decline me and I say why, and you say, well, it's because you have too many loans where you're late in making your payments. And I go, I'm going to show you. I'm going to show all of you. And I walk out the door. And I go and I'm like, I'm gonna pay back all my loans on time, and then I'm gonna go and I'm gonna rub it in Zach's face. You're going, fantastic. Go do that. That would be amazing. Please come back once you've done that. Like you show me. Like
come rub it.
Yeah, exactly. Like the behavioral change that happens if you try to game that algorithm is you just become a better credit risk, right? So the system we have works very well for that. Where the innovation comes in with this stuff is mostly on the margins. So there is a fairly large percentage of American consumers that don't have a full credit file that you can calculate a credit score against. And that could be because you've been serving in the military. It could be because actually you're older and the last credit card you had that you used was 20 years ago and your credit file has kind of gotten stale since then.
Wow, I hadn't thought about...
That's an interesting one, isn't it?
Yeah, I hadn't thought about the other end of that spectrum.
Yeah. Like actually elderly people have a difficult time accessing credit because they paid off their mortgage years ago. They don't have a car loan. They operate mostly in cash. They don't use a credit card.
Even if you're... See, this is the fascinating stuff about it. And I think these are the places where people start to sense a lack of fairness. Right?
Yes. Yeah.
Where you get to a point of like, I've been a good credit risk my entire life.
Totally.
Turns out I've not needed credit over the last 10, 20 years.
Yep. Now
you're telling me I'm a bad credit risk because I haven't needed credit and taken advantage of the credit system and function inside of it. Wouldn't I be a better credit risk?
No, exactly. I mean, like it's a really good point, right? Like you have say you have a credit card. This is a piece of advice I used to give when I taught credit to high school students because I was an expert.
Let's get a little 18-year-old Alex in here.
Yeah,
there we go.
One of the things you don't want to do is if you get a credit card, you always want to keep it open. Like your oldest credit card, you want to keep it open. Why? Well, because after you close an account, that trade line will stay on your report for 7 years, but after 7 years, it ages out and it's gone. So you imagine someone who's 65 and the last credit card they had was 20 years ago. That's aged off, right? And so they have like no active credit history. And so they're actually pretty difficult to score. But to your point, it's not very fair because They're very financially stable. They're very responsible. They've used credit in the past very responsibly. So how do we help that person? What do we do?
Yeah. And how does it not become some weird additional level of unfairness? Because what you just described actually would benefit an unbelievable number of people, right?
Absolutely.
Like, I think before I realized a lot of things about what the hell I was doing, ironically, a pedal card. I think I closed a pedal card of all, speaking of cash flow underwriting.
Yeah.
And I think that was about 6 years ago. So I think it's going to drop off soon, but it had a significant effect.
Yeah.
And I am looking forward to it. I mean, my credit score's fine, but like looking forward to it dropping off.
Yeah.
But didn't realize that, and it's just so interesting how the two sides can like fight with it. Like it's fair, but it's unfair at the same time.
Totally. No, and so the question really is, again, like on the margins, and the margins are big. There's a lot of people who are being excluded from the credit system or aren't getting the best prices for credit, and that's bad because if you need credit and you can't get approved by a bank, your alternatives at going back to check cashing are not great, and so
terrible.
Yeah, we really don't want to push people to lending alternatives. We want them to be in the mainstream. So if you're 18 and you've never had credit before, if you're 65 and the last time you had credit was 20 years ago, if you're a recent immigrant and maybe you had great credit and great banking relationships in another country, but you've just moved to the US, all of these are populations that we need to figure out a way to score. And so where fintech has come in has basically said, where can we fix all of the problems on the margin? And there've been amazing innovations, right? So to give some examples on the immigrant one, Nova Credit, I think you know those guys.
Of course.
They built a credit passport and it's really tricky to do because you have to basically say, all right, any country that someone might come from, what has an existing credit system, let's build integration so that they can take their credit data with them. We can normalize it in a US credit bureau context and then score them based on their history. Seems completely fair and logical, but the bureaus in the US didn't build that. FICO didn't build that. It took fintech to come in and build that offering, right? For cash flow underwriting.
Can I ask one on that?
Yeah.
How much of it feels like there's so many versions of that could be built.
Yeah.
How much of that comes down to a FICO or one of the credit bureaus accepting any of that data? Like, is it on that? Like, is that a regulatory thing, policy thing, or is that just them making a business decision if that's helpful or unhelpful data?
Yeah, it's a really interesting challenge, actually, and I'll give you a really precise example of that. All of this stuff sort of sits at the intersection of FICO and the bureaus have a monopoly on the market. And it's a weird monopoly because FICO and the bureaus are sort of together, but then they also fight with each other. Like the bureaus have their own credit score that they compete with the FICO score on. But they also, I don't know if people know this, but the bureaus distribute the FICO score. FICO actually doesn't sell a single score directly. It all goes through the credit bureaus.
That was and that's why it's always confused me. Like if you're getting data from this one source, but it's going to different companies, it just like there's just a filter, an additional layer of data inside of the different companies that is creating the different scores. Is that the idea?
Yeah, basically. I mean, all of the credit bureau's data is all pretty commoditized at this point because every lender mostly furnishes data to all three bureaus. So the bureaus will tell you, oh no, our data is better than this one. But like the data is the same at all three credit bureaus. So there's very little difference or value. And mostly what happens is a lender will negotiate with one of the credit bureaus to say, hey, we want to buy 50 million credit files from you next year, and we'd like to buy them at 12 cents a pop. And if you don't give us that price, we're going to go to your competitor down the street and get the same product for 12 cents. So you should give it to us for that.
So basically, how we got to 08 with the rating agencies.
Yeah. It's kind of a race to the bottom, right?
Yeah.
And so that is, I think, really important as a dynamic to understand. But yeah, the credit bureaus and FICO, they kind of have a bit of monopoly on the system. And so the thing that you worry about is, okay, they're not doing this thing. They're not helping immigrants who move to the US. Well, why? Is it because it's anti-competitive and they don't want to and it would be bad for their business? Maybe. Is it because they're just large companies that don't move very quickly and they're just kind of innovator's dilemma, like they just don't do stuff they probably should do? A little bit. Is it because they have a very experienced and sort of vested interest in making sure that the credit decisions that we make in the US are of the highest quality and that they don't want to pollute the data or lower the value of the score and get us into sort of an 08 situation again? Yeah, a little bit that too. I mean, I know people obviously who work at FICO, they're amazing and they really take this stuff seriously and they care about making accurate credit decisions and not, chasing commercial objectives at the cost of making bad decisions. So there's an element of that too. So all of these things get layered in. And then you also add into the fact that regulators and legislators will throw their weight around in this space every once in a while. And sometimes they're doing that because they're looking out for consumers, that are trying to protect the integrity of the banking system. And sometimes it's because Elizabeth Warren is kind of mad about something, and so there's all these conflicting things that come together, and then people start complaining about the credit scores. So, I mean, to give you an example, I probably have written more and more passionately about credit builder products than anyone in the history of planet Earth. Like, it's going to be like on my tombstone, probably.
You've put a flag in the ground.
Yeah. I have thoughts. If anyone is thinking about credit building, like, please talk to me before you do anything. I have a lot of thoughts on this, but it's a really interesting category because on the one hand, go back to when you were 18 or when I was 18, not a lot of great options for starting your credit journey.
Especially at that point.
No, I mean, there was nothing. And like, I don't think people really appreciate this, but like, you'd go to a bank's website, they'd have all these different credit cards and you'd be looking through it. It's like, not going to qualify for that, not going to qualify for that. You get down to the very bottom of the list and they're like, here's our secured card. Mm-hmm. And I'm paraphrasing a bit, their marketing, but not that much. This is for losers who don't know what they're doing. And you're like, cool.
It's either positioned for 18-year-olds or like, whoo, get it together.
Well, and even the 18-year-olds, they're like, what, you don't understand how this works? You need a secured card? Like, what's wrong with you?
Yeah,
like,
you're right.
It's not built for like, oh, don't worry, this system doesn't make any sense, but we're here to help you. Like, that's just not how those products were built. And so there was a need for better on-ramps into the credit system. And so fintech came along and said, wow, credit building looks like a good category. And they were right. Like, you go to Chime's website and Chime doesn't make you feel embarrassed for not knowing how this stuff works. And they're like, here's a card, here's how it works. We can help you. Don't worry that you don't understand it. Like, that's amazing. I love that. But the problem is that, again, all those conflicting objectives, one of the objectives that everyone in the space has to have is we have to make sure that the data that we are reporting to the credit bureaus and the scores that we're building on it help lenders make the best possible decision. And anything we do that screws with your ability to make the most accurate decision, meaning that people who are good credit risk get the best pricing and people who are bad credit risk get the worst pricing. That's how the system has to work in order for just like lending to function. Fintech companies early on with credit building, and this is starting to change, which is great. Early on, they didn't care so much about that. They were like, it's not really our problem. And so they would design these credit builder products that were very consumer friendly and that basically made it like push button easy to just build credit. So you're 18, use this card. It's not a credit card. It's like a debit card, but you swipe it and through some complex mechanics that we'll do on the back end, we'll just only report positive data to the credit bureaus. As an 18-year-old, who wouldn't want that, right? Like, that sounds amazing.
As a proposition, it sounds hard to say no to.
We're just going to make your credit score go up. It's going to be awesome.
Right.
But the thing that I don't think people really realized at the time was if you are not actually giving consumers an ability to sink or swim with credit, meaning like, we're going to give you this card, you need to use it responsibly. And if you do, we're going to report positive data to the credit bureaus and you're going to be able to build your score and it's going to be good. If you don't, we're going to report negative data to the bureaus and it's going to hurt your score. So just be careful with it. Use it in a responsible way. Instead of doing that, if you just design the product to only report positive data, which again, like, it's very consumer friendly. You can see why fintech companies would want to do it that way. The problem is the data that's being reported to the bureaus, no one can trust it. And so what's happened, and I actually know this for a fact, is that a lot of lenders, banks and others, are now actually screening out those trade lines in their underwriting decisions. And so if you go to Capital One,
wow,
and you say,
I did not know that.
Yeah. So like, let's say you've been using, I'll just pick on Chime. Again, I like Chime, but like, if you've been using Chime's credit builder product and it's been building your credit and Chime's telling you, hey, you have a 720 FICO score, like, you're good to go. Go out there and apply for credit. You're going to go to someone like a Capital One, you're going to apply and they're going to decline you for credit. And you'll be like, why? And they'll be like, they don't usually give you very useful or like super specific reasons, but they'll say something like, insufficient credit data or something like that. And you'd be like, what the hell? Like, I thought I had a 760 FICO score.
Right.
And you do, but Capital One, they've built their own credit model and they actually have went in and screened out your Chime credit builder trade lines because they can't trust them, because the data is not a useful reflection of your actual risk. So it's actually hurting consumers, not because the impulse is bad. The impulse is good. Like, let's bring more people into the credit system, but you have to design these products right. And a lot of these early credit builder products were not built in the right way.
I feel like there's a general takeaway in fintech and financial services where you don't, well, maybe this doesn't apply to some of the CEOs post 08, but you generally don't get to have your cake and eat it too.
Right.
Like, good.
No, that's exactly right. I posted I think like a Venn diagram or something maybe on Twitter, and it was like credit building. You can have two of these three things, but you can't have all three of them. And the three things were broadly accessible, meaning that like it's a consumer friendly product that's open to a lot of people.
Yep.
Quick and easy to build, and reports good signal to the bureaus. You can have two of those three things. You can't have all three of those things. And the problem, to your point, with a lot of sort of early building in fintech, and again, fintech has matured as an industry. I think we've gotten better on a lot of this stuff. But a lot of the early impulse was, I got to ship quickly. I got to ship this product. And so people wanted to build the absolute best product for customers that could cover as many people as possible and that they could get to market as quickly as possible. And so there were shortcuts that were taken, and things like reports good signal to the bureaus was just not something that they worried about. Another example of this is buy now, pay later, right? And I generally, it's kind of a hot topic, but like I think buy now, pay later is a good thing, net for the industry. I think it's a good product to have in the space, and generally I like it. One thing that's interesting though is that pay in 4 buy now, pay later, so the little 6-week loans that you get to pay for a pair of Adidas or whatever, none of those are reported to the bureaus.
Not reported at all, or only reported if paid back?
Not reported at all.
Oh, I didn't realize. I thought it was similar to what you were talking about before, where it was only upside, no downside, and then
just
not trustworthy.
Nothing at all. And so,
what's the underlying reason for that?
Well, it's interesting because there's, and again, like confluence of different reasons. One of them is the credit bureaus were not ready for buy now, pay later. And so if you think about the types of data that the credit bureaus take in, they take in installment loans, they take in credit cards. Buy now, pay later, that pay in 4 product type, it's kind of a loan, but it's also kind of a revolving credit card. Plus, it's also kind of a payment mechanism. Yeah. So it doesn't fit cleanly in the credit bureau's data set. It also is not something that the classic FICO score knows how to like think about or understand or figure out. So the credit system wasn't quite ready for buy now, pay later. That was part of the problem. But another part of the problem is buy now, pay later companies built, we're not going to hurt your credit score and we're not going to rely on your credit score into the value proposition of their product.
Right.
And so they said like, oh, no credit score, no problem. Or, oh, you want to use this product, but you're worried about maybe hurting your credit score because you maybe aren't like a super good borrower. You can use us. We won't report anything to the bureaus. So it's like kind of a shadow credit system, right?
It's kind of the most American innovation you can have.
It really is. It really is. And not to go all history on you, but like merchant-led credit at point of sale is a process that goes back a long time.
Yeah.
Like we digitized it with buy now, pay later, but it's an old idea. It's very, very American. And so like that system is one where you kind of don't really want to furnish the data. Plus, the other thing that's interesting about all of this is go back to the 1970s, 1980s and interview bank executives and say, hey, what are like the most valuable assets you as a bank have? I guarantee you they wouldn't have said data at the time. No one thought that way, right? Like no one knew what computers and the digital revolution was going to do. Fast forward to today, if you talk to a fintech executive, like the folks who run buy now, pay later companies, you go, what are your most valuable assets? Data is right up there towards the top. And so when the credit bureaus go to the buy now, pay later companies and say, okay, we weren't ready for you a couple years ago, but we're ready now. Like we have a new way to take in your data. We want this data. And we think it'd be useful for the ecosystem to have this data, which it would, right? Like, Zach, if you have a really good credit score, but you also have stacked up 9 buy now, pay later loans of varying levels of repayment across a bunch of these different providers, like that's something that I as a lender would want to know. They've gone to the bureaus and said, hey, we kind of like this data. The sense I get is that the buy now, pay later companies aren't exactly thrilled about the idea of handing that data over because they view it as their data. They don't really want to share it. And they're a little worried that it's going to undermine the value proposition to the customer because, hey, what the hell? You said you weren't going to report my data, and now you started reporting and my credit score went down. So there's a whole bunch of fintech innovation that's happened on the edges. And the question I'm just fascinated by is how does all of that fintech innovation eventually interface with the existing system we have? And the credit bureaus are a great example of that system. And the credit bureaus, I wrote a piece about this. Fintech is kind of breaking the credit bureaus because a lot of the things that fintech is doing, the credit bureaus aren't ready for. But I also know a lot of folks who work at the credit bureaus, and they've been working really hard over the last 2, 3, 5 years to get ready for fintech. And now they're going back out to fintech companies and saying, hey, like we want to work with you. And those conversations are a little rocky at times. And so that's kind of the point in that evolution that we're at right now.
Do we need another credit bureau?
Yes, we absolutely do. So I'm glad you asked, because Nova Credit is a credit bureau, right? Plaid is now a credit bureau. They are a consumer reporting agency.
I knew they were I knew they were a consumer reporting agency. I think my monkey brain didn't put together that meant
credit bureau.
Huh.
So they're a credit bureau now.
Are there other reporting agencies? Can you be a reporting agency without being a credit bureau, or are those pretty much interchangeable terms?
Mostly they're interchangeable. The Fair Credit Reporting Act, which is the law that governs consumer reporting agencies, it has a broader set of uses beyond credit. So there are consumer reporting agencies that focus more on like employment screening or screening for tenants. So there are some other kind of non-credit ones, but for the most part, the terms are synonymous. And Nova Credit got into it years ago because they were doing that credit passport thing and they needed to be a credit bureau. Plaid just got into it because they're going to do more in cash flow underwriting and working with lenders. So they need to be a consumer reporting agency. So yeah, the credit bureaus have a lot more company than they used to, which I think is fantastic because to me, if you're going to come in and play under FCRA rules, Fair Credit Reporting Act, the more competition, the better. And a lot of fintech companies, fintech infrastructure companies like Plaid and Nova and others have decided we're going to do this thing and we're going to compete at that level. Or you have other companies like Prism Data that was spun off of Petal, or someone like a Pave, who are not trying to be CRAs. They're not trying to compete with the credit bureaus. They're trying to build the next FICO and trying to compete with FICO. And FICO is not a credit bureau, but they work in that space. And so if you think about, the way I think about it is, there's an entire stack that we've built over the last 60 years for granting credit in the US. And there's the credit bureaus, there's FICO, there's credit decisioning companies like Zoot. There's just this whole stack of providers that lenders rely on. Now, in a consumer permissioned world, so open banking, payroll APIs, all this stuff, we're going to need to rebuild that entire stack again. And you see data aggregators like Plaid and Finicity sitting at that bottom part, kind of trying to compete with the bureaus. You see the Prism Datas of the world trying to compete at that FICO level. And that whole stack is going to need to get rebuilt. And I think that's what's going to happen over the next 10 years.
I know we're coming up on time because you got to go get them hairs cut. But I want to ask you at least one more question, which is, if you were a founder, like how we've used none of the questions, by the way.
It's my fault.
No, it's not. It's just like, I don't know why I put questions together, really, because it's you and me and we just talk. If you were a founder.
Yes.
Thinking about FICO being the gorilla that it is.
And it is.
Seemingly, from my perspective, uninterruptible.
Yeah. That's the general consensus, is like impossible to disrupt.
Okay. So that's not just me. Thinking about that, thinking about the, whatever the correct term is for a monopoly that has three in it, not a duopoly, a tropoly, whatever.
Oligopoly, yeah.
I guess anything over
two?
Over two would just be an oligopoly.
I don't know. Probably there's a better term.
Check us, internet.
Okay.
Oligopoly. And thinking about all these other layers in the stack.
Yeah.
From your perspective, where would you go build? And I guess the second piece of the question, if you had, where would you go build rationally? And where would you go build with unlimited funds?
Ooh.
Like if you just got, if Elon got mad about it as he gets mad about everything and was just like, Alex Johnson's going to be the one I give $2 billion to go solve this problem to.
I love it.
Like, give me the rational version and then the like pie in the sky version.
That's a good one. I think the rational version would be, I would build at that FICO analytics layer for open banking. There are a couple companies that I mentioned that are doing that. There's so much value to be unlocked there because consumer permission data tells you a lot about consumers that you just don't get from credit files. It's deeply complementary to the data that we have in the credit files. And we have, from an analytic perspective, we've extracted every ounce of predictive value out of credit data. Like the smartest, most sort of undirected people who are just like, I just want to make money. All of those people have been looking at the credit data and trying to figure out better ways to, like, if you have an idea for how to do that, you can go get paid $800,000 a year at Capital One. Like we've put a ton of money and time over 60 years in extracting as much value out of that data as possible. So there's really not much lift left there. Open banking data, by contrast, no one's really done that much yet. Like, we're just starting to build scores. We're just starting to build attributes. I was talking to Jason at Prism Data Pedal about like a new thing they rolled out where they're using cash flow data to predict first-party fraud. And there's like all kinds of interesting signals in cash flow data and bank account data for finding first-party fraud, which I don't think anyone has ever really looked at before.
Makes sense, though.
Yeah. So like, I think there's 60 years worth of value to be extracted from open banking data at an analytics level. So if you're a smart data scientist or you can go hire those people, go build in that space.
That was an endorsement of Plaid if I've ever heard one.
Yeah. I mean, Plaid's going for it. There's a bunch, right? And like, I think people underestimate. Lenders are excited about this data. They have no idea how to use it.
Well, that's fintech, but yeah.
Yeah, no, I mean, it really is. And so I think there's a lot of value to like helping people in that space. My irrational answer is that we use the FICO score for a bunch of different stuff, right? Lenders use it to make decisions. The secondary market uses it to securitize loans, right? Like when people buy loans on the secondary market as investors, the FICO score is one of the main criteria they look at for figuring out which loans they want to buy. Very valuable across a whole bunch of different areas. It's also used by consumers as a placeholder to understand how well they're doing. Mm-hmm. So it's a metric for consumers. And quite frankly, it's really the only number that we have in financial services that tells you as a consumer how you're doing. Whispers, because FICO might be listening. They might not be happy about this. It's not a very good number for where we're going, right? Because it's only based on credit file data. And so much of what's happening in consumers' lives financially sits outside of that. Obviously, we've talked about what your bank account data tells about you that your credit data doesn't tell about you. You're using all of these financial products, not all of which report to the credit bureaus. There's just so much about you as an individual that lenders would want to know holistically in order to evaluate you as a credit risk. Not all of that is captured in the FICO score. And the FICO score, again, it wasn't really meant to be a broad measure of financial health. We just use it that way because we don't have an alternative. Yeah. So if Elon gave me $2 billion to go build something new, I think what I would try to do is build a consumer-facing service that helps people understand holistically their financial health and their credit worthiness, and then be able to take that kind of in the fashion that you use a passport to go get places, take that as a passport to go to a lender and say, I am much more than my 3-digit FICO score. Here's all the other things about me, and here's an analytic framework and a number that can help you understand that. Let me bring all of that to you. And in a consumer permission data world, I think we can create something better as a consumer-facing metric for financial health and credit worthiness that goes beyond the FICO score. And so I think there's a way to attack that. It would take a lot of money and a lot of marketing and a lot of infrastructure work to build that. But I think
lobbying.
There's a lot of lobbying. Yeah, exactly. I mean, you'd have to attack that on a lot of different levels to get that to happen. But I just don't think the score is a very useful representation of who you are from a financial services perspective, even though we still use it that way.
Yeah. I'll say one thing to make up for FICO, which is, it feels like everything we're talking about in this whole conversation has actually been innovation happens.
Yeah.
Proper credit decisioning needs to be the center of the thing at the end of the day.
Yes.
And it is going to take time for our most responsible and most aged and kind of established incumbent institutions to take that in, because they have to be the most responsible. They have to do that. Like, it's similar to a lot of the things we've seen in banking as a service, where, you run really fast and then the regulators catch up and yada, yada, yada.
And then you have to work with the adults in the room, right? And no, I could not agree more. And again, like, I worked at FICO. I've worked with the credit bureaus very closely for many years. Really smart, responsible people who want to do the right stuff working at all those companies. And fintech moves fast. It's hard to catch fintech because it's moving 1,000,000 miles an hour.
And some of it you probably shouldn't. You should wait to see how it works for 5 years
100%.
Before you take that data
100%.
in, right?
So I think we're at a really interesting inflection point right now where a lot of these innovations that were brand new 5 years ago are mature now.
Right.
And the credit bureaus and FICO are ready for them now.
Right.
And so again, if you're like a fintech founder or builder listening to this, engage with those companies. Like, they want to talk to you, they want to work with you. And I think there is a lot of joint value to be created there as well. It's not all about disruption. And in fact, in credit and credit scoring and lending, it's a lot more about collaboration than it is about disruption. And I think that's something that the whole ecosystem needs to adopt as a mantra.
Alex, thank you, my friend. Let's go get your hairs cut.
All right. Appreciate it.
Hey, thanks for listening. If you're still listening, you're probably reaching for your phone to pick your next podcast or switch to music or just call it a day because you can't believe how much valuable information you just took in. But before you pick that next thing, don't forget to rate, review, subscribe, tell your friends, and all that jazz. Generally scream from the rafters about how much you love Fintech Family Hour. Thank you again to our sponsor, FS Vector. And until next time, stay healthy, keep your head high, your costs low, and I love you all.